All right, well, hello everyone. This is Nick Gonzaga with another Rocket Dollar presentation. We may have met over the phones since I'm one of 3 people at Rocket Dollar taking inbound calls. Now, the purpose for this presentation is to bring investment opportunity awareness to current and potential Rocket Dollar members. This time we're bringing in Farmers Business Network with Managing Director Michael Sesko, who has a dual master's degrees from Yale in environmental finance and roughly 11 years of experience in agriculture technology. Did I get that right?
Yeah, that's mostly right. I've been in the kind of the digital side of agricultural technology for the last decade or so.
Oh, fantastic. Okay, so real quick, just a few points of today's presentation. Talk about how farmland investments work in an inflationary environment, the Farmers Business Network difference, and an overview of this specific opportunity. And at the end of it, we're going to have a brief town hall question and answer session for all of the webinar attendees. So I'll go ahead and turn it over to you, Michael. Thank you.
Awesome. Thanks, Nick. So I'm going to walk everyone through a few slides just to kind of give you some background on who FBN is and the investment products we're building. And then, yeah, write down some questions. Would love to have a conversation at the end. Here's the disclaimers. So most people that have heard of a Farmers Business Network know it as an ag tech company. It's one of the largest direct-to-farm ag tech companies in the world. You know, we started our business by offering crop inputs. These are things like seed and fertilizer and chemical inputs at a discount, or offering transparent pricing to farmers. Through that, we got a lot of interest. The farmers obviously like that. They're paying kind of marginal costs for inputs. And then, you know, we started layering on other services. We realized we had a critical mass of farmers that were really interested in the platform and what we could do for them. And so we've aimed to, you know, add a digital experience to almost everything a farmer does, everything from purchase of crop insurance to marketing of crops to purchasing a mortgage. And so this creates this kind of flywheel and platform that we've been building. And the fintech side, or the investment side, is one of our newer products. A couple of years ago, we started offering mortgages for farmland, as well as operating loans and equipment loans. And we've noticed a real opportunity to be looking at the equity side of investment tools for farmers. And I'll get to that in a second. This is where Farmers Business Network shines, and this is where we are. You know, we're at 30,000 plus member farms across 80 million acres. This is in the US, Canada, and Australia, and growing. And this is what really makes us unique. You know, we've got a really dedicated group of farmer customers that come to us for these products and services. And, you know, we see this as an amazing opportunity to be offering new financial services to these farmers. So the genesis of Farmland Capital is that, you know, farmers need land to farm. Land is very expensive, and banks will only finance usually up to 60% LTV. We've built a minority equity co-investment product to help farmers finance that existing 40%. This can be on new or existing land. So I'll usually give an example with simple math. Like, let's say a farmer wants to buy $1 million farm. They'll go to the bank, they'll get 60% in mortgage and a conventional loan. That 40% that's remaining has to be put down in cash in terms of their equity. And so what we'll do is we'll put down up to 49% of that. So in this case, we'll put down 200,000, the farmer will put down 200,000. And over time, we don't collect interest or rent. This ends up being a really flexible product for farmers. They like it because it allows them a little bit of headroom to weather, say, bad weather years or bad commodity price years. But what this instrument does is it allows us to participate in the appreciation of farmland over time. In a few slides, I'll show you kind of how farmland is performed, but we really like the performance of farmland given, you know, super strong fundamentals. And, you know, we've looked at going back to 1940, farmland's appreciated about 5.9% on average per year. These investments are structured as a leveraged option. This has been applied in the residential real estate market in the past. What we effectively do is we'll invest $200,000 and we're able to participate in an accelerated amount of the appreciation. And that really depends on what kind of farm it is, where it is, what the risk factors are. But typically it's a 3x percentage. So in this case, we're putting down 20% of the farm, which is about 49% of the equity, and we'll participate in about 60% of the appreciation or depreciation of the farm. It's a 10-year term, but farmers can buy it out or sell the farm at any time. We want to offer the flexibility to the farmer. And we've gotten great reception. We launched this product basically late last year. We've seen the following 4 use cases come out. So it's a new farmer wants to buy new land. So in that case where we found a property for $1 million, they put down 200, we put down 200, the bank puts down 600. The investor now owns a small portion of that farm backed by a deed of trust through this option agreement. For farmers that want to refinance, and this has been a lot more common, during a low interest rate environment, we can also access the equity that already exists in the market. There's about 50% of farms are owner operated. So there's a big market there to provide this equity solution to farmers that are already owning these properties. What we find is that by investing equity at that stage, we're also improving a lot of their financial metrics, which allow them to qualify for a low interest loan. So their annual interest payments go down, their overall cost of capital goes down with the injection of this capital. The other one is keeping the farm in the family. So if you look at the average age of the farmer in the US is 60 something and growing. There's an expectation that 25% of farms are going to change hands in the next 10 years through succession. Oftentimes when a farm is handed down to other family members, it might be a 5th generation farm, but not all the siblings want to farm it. There might be 1 or 2 brothers or sisters that want to stay in the business. This co-investment allows those family members to buy out the others without added capital. And the last use case is really getting access to farm equity. So if you're later in your career and you're a farmer and you own your land, it's most often your most valuable asset. At that stage in your career, you typically don't want to take out more debt. It burdens you with more interest payments and more risk. So taking out a co-investment allows you to access some of that capital. You can spend it any way you want. And the investors get access to that piece of land and its appreciation potential over time. So what we've done as a company, typically, historically, our customers have been farmers, but now we're opening this up to investors. We're matching these co-investments with investors who are interested in farmland as an asset class. What we're building are special purpose vehicles that provide access to either single or diversified portfolios of these farmland investments. These are offered only to accredited investors under the 506C offering. When we look at returns, they tend to be in the 11 to 13% gross IRR basis. These are all based on appreciation of land. The way we think about that too is if you were to make an investment in a farm, just owning it outright, you typically get kind of 2 to 3% current income, either from renting that farm or farming it. And then you add appreciation on top of that and a little bit of debt, and it gets you to kind of like a 7 to 9% gross IRR. Because we're not taking that current income throughout the life of the investment, and it's really focused on capital appreciation longer time, there's a premium to it. So we're getting about 100 to 200 basis points on average per deal as we look at the IRR opportunity over 10 years. So there's other farmland investment companies out there. A lot of them are great models, but where I want to point out some of our sources of differentiation that I think really make us unique and make this a really interesting investment. When you look at aligned incentives, when we co-invest next to a farmer, they have majority ownership and control, and they have a path towards long-term ownership. The desired exit for the investor here is for the farmer to buy out the option over time. What we like about that is that the farmer wants to then treat that property as if it was entirely his own. So they're going to be doing the right thing in terms of soil health improvement practices, improving any kind of infrastructure that's on the property. We feel that we're very tightly aligned with how the farmer will manage that property as their own longer term and create value for both us and the farmer. It comes with lower costs. So all our deals come from farmers themselves. So instead of us going out and talking to brokers in rural America, we have farmers coming to us saying, hey, I want to buy this property. Hey, I want to refinance this property. So they're sourcing these deals. In the case of refinancing, oftentimes these farms have been in the family for many generations that have never seen the light of day. And so we're getting access to really high quality farmland that other farmland investors aren't getting access to. Typically people that live in these communities are paying insider prices. It's not like some private equity firm coming from outside. And so we're able to partner on what that entry price is. And over time, the farmer is managing the property, right? So we're not paying a property management fee. We're not paying a broker fee to get access to that property. The total addressable market is really exciting. So when you look at farmland investment, approximately 2% of farms go for sale every year. All the farmland investment firms out there are kind of fighting for these properties, as well as existing farmers out there. But when you look at the 50% owner operated metric, again, this allows us to participate in equity that's out there without fully owning the property. So we're providing investors access to this really high quality asset class that other investors really aren't getting access to. We talk about quality a lot. Gresham's law is this notion that in an open market, sometimes like the worst assets are traded. In this case, assets that are already protected by the family and already in ownership and will stay in farmer ownership longer term, we feel make some of the best investments. We also have a significant data science platform that we've built to really understand these investments. Before underwriting these properties, we do an extensive diligence, both in terms of underwriting the farmer, but also the farm. And so we're able to look at things like satellite imagery to really estimate historical performance. We're able to look at crop rotation history. We're able to look at certain risks as it relates to water, really giving us a kind of a robust approach to really understanding, is this one of the best farms in the county or one of the worst farms in the county? And then impact, something I'm personally very passionate about. But by co-investing alongside farmers, we're empowering them to own land longer term. So if you were to compare this to another institutional farmland investment model where institutions own the property and rent it out to farmers, where they often get marginalized, this is really allowing farmers to have a path towards ownership and keeping farms in farmers' hands. It obviously comes with that in-line incentive, but we also love the fact that we're powering farmers in rural America. We also find that with ownership comes this instinct to take care of the property in a better way. So when you look at environmental impact, the hot topic of the day right now is carbon and soil organic matter. When you own the property longer term, you're more incentivized to be investing in soil health improvement practices, things like cover cropping or conservation tillage. These are interventions that often take many years to pay off. And so for the renter that's renting year to year, they're most likely not going to engage in that kind of practice because they might not be able to see the payoff longer term. So we're seeing a lot of cascading benefits that are coming from this co-ownership model. So why invest in farmland now? One of the hot topics of the day are obviously inflation. We're at 7.5% inflation. If you look at the chart on the right, we looked at correlation of farmland as an asset class relative to other assets. We looked at gold, bonds, S&P 500. And as you can see, it shows a distinct correlation to inflation, meaning it performs well in inflationary times. But it also has a negative correlation to the stock market and bonds. This means that when those markets are super volatile, this ends up being a great way to diversify your portfolio. And we're not suggesting you put 100% of your portfolio in farmland, but we think it's a great way to kind of put part of your portfolio or your IRA, something that's a longer term in nature investment, so that you can could work through some of these more volatile times that we're currently seeing right now. I talk about supply demand imbalance a lot. Population is going to 10 billion plus by 2050. There's a lot of mouths to feed. Farmland, we're not making any more of it. If anything, a lot of it is going away due to development pressure. And so we see a really strong fundamental case to investing in farmland longer term. As I mentioned earlier, the average historical appreciation has been about 5.9% per year since 1940. And we've seen a huge bump up in this current year, mostly due to low interest rates, high commodity prices, and this inflation topic. When I talk about risk-adjusted returns, it's mostly the Sharpe ratio. For those that are not familiar, this is just basically looking at performance relative to volatility. So farmland has really strong characteristics in the sense that it's in double digits performance against a low single-digit volatility metrics that we look at in terms of standard deviation. Why is this important for you guys, the self-directed IRA members? When we talk about diversification, I already hit on those points. You're getting into an asset class. Historically, like when you're investing a 401k or an IRA, you're only getting access to market indexes. We feel that farmland is a great way to complement those investments and really protect your portfolio longer term. We feel the duration and returns associated with our co-investment are really appealing to investment like an IRA. We don't take current income from the farmer, so this is really just about long-term capital appreciation. For people that really want current income, look at it like a fixed income instrument. They can look at other farmland investments where they're getting maybe a 3 to 5% cash yield. In this case, in your IRA, you're not really able to even access that cash yield. So we really focus on long-term capital appreciation of the farmland asset. And for that liquidity risk, we actually get a premium IRR, as I mentioned before. It tends to be in the 100 to 200 basis point range. The last point for IRA folks is the UBTI tax. A lot of folks that I've talked to in the IRA space are super aware of this. Anytime you apply leverage to an investment, it usually triggers the UBTI tax. Because these options are leveraged, but not using leverage in the traditional sense, we're not raising bank financing. It allows you to sidestep that UBTI tax and protect the investment that way. So those are my slides. I intended this to be more of a conversation. Happy to touch on any of those points in greater detail, talk to you more about my experience about Farmers Business Network as a company. We've got some live deals that are available right now. You can get in touch to talk about those. As I mentioned before, we're only taking investments from accredited investors. And so make sure that you're satisfied on that point. We can have that conversation. But I'll stop there and pause and see if there's any outstanding questions right now from the audience or from Nick.
Thank you so much, Michael. That was very informative. And I do appreciate you mentioning the unrelated business income tax, the UBIT. We do get questions about that from time to time, and it's really nice that Farmland wouldn't have that. One question came in, and they were asking, I think Ed Kelly asked if it was eligible for a Roth IRA, and yes, it is eligible for a Roth IRA through Rocket Dollar. Next question is, typically, how many farms are bundled in any investment deal?
That's a really good question. Some of our early deals, we were just doing distinct deals. And so our investments range in size from 200K all the way up to, 5+ million. And so what we like to do is package them up into groups of anywhere from 2 to 10 farms, where we're giving investors diversification in terms of crop and geography, and really allowing them to put smaller dollar amounts. Let's say you're investing $10,000 or $15,000, you're getting access to those 10 farms at that point. And so if there's a weather event in one part of the country, or if there's a commodity price change in a certain type of crop that they're growing, this gives you greater protection and diversification against those kind of idiosyncratic risks that we'd be seeing. So I'd say anywhere from kind of 2 to 10 investments per packaged investment per SPV.
Okay, great. So that's protects against one of the questions that came in was about a farm crisis in the 1980s. So I guess that is basically an answer for that question.
Yeah, in some ways, the farm crisis of the 1980 was a large macro event. This was the result of massive inflation and massive interest rate hikes over prolonged periods of time. And so, that is something that's likely to hit most geographies and most crops at the same time. But we've pulled out of that, and we're kind of in a much better place now as it relates to farmland fundamentals.
Great, thank you. And the minimum investment amount, what would you say?
It differs per SPV. So I would say on average, it's anywhere between $10,000 and $20,000 per SPV. But it really depends on the size of the investment opportunity and the number of investors we're targeting.
Fantastic, thanks. So another question was, how does a 10-year buyout mechanism work? Would you be able to detail leverage option mechanics just a little bit?
Yeah, 100%. This is a question I touch on all the time. So the way the buyout works, I'll go back to the $1 million farm example because it's just simple math. We make a $200,000 investment in the farm. That's about 49% of the equity. That entitles us to 60% of the appreciation of the farm. So let's say in 5 years, the farm goes from $1 million in value to $2 million in value. We then participate in 60% or $600,000 of that appreciation, plus we get the $200,000 principal investment back. And so that's basically how the math works on the option. When we think about the buyout and the liquidity, we wanted to give the farmer flexibility. There's things that change in their operations, whether they might have a really great year or they might have a really bad year. They want to wait longer. They might have a relative that gave them a bunch of money and they want to buy the investment out. And so we want to give them that flexibility in terms of what was appropriate for their business and their business operations. And so at the end of 10 years term, the farmer has to either buy us out or sell the property, but they can also do that anytime throughout the life of the investment. We find the IRRs tend to be pretty consistent throughout. And they could buy us out in year 1, year 3, year 8, year 10, whatever makes sense for them. When you're looking at a pooled product, when you have, say, 10 farms in an SPV, that capital will then be returned to the investors. And then the SPV will wind down basically once that 10th farm has been liquidated at the end of those 10 years. We are also looking at longer term products. I know for folks in IRAs, depending on their age and when their planned retirement is, we are looking at investments that could go 15, 20 years as well, as that appeals to some farmers that have bigger properties that might take longer to cash flow. So we'll see that on properties like permanent crops. I should have mentioned too that the properties we look at include all types of crops and geographies in the US. FBN, as you saw from that initial map, touches almost every crop type and every geography. And so while the core of our products are mostly available in row crops, we also offer investments in pasture as well as permanent crops, which are typically seen out in the West.
Oh, thank you so much. I mean, we did have a question that was along the lines of how the model of farmland investing before it's broken, but it seems pretty obvious with all the different technologies that you guys have. You have a data-driven approach to making these investments, correct?
Correct. And, I think broken is a strong word, of course. As I think about, the traditional farmland investment, people didn't really start investing in farmland as an asset class until like the 80s or 90s. And what it really was a beta play back then. It was getting institutional investors access to the broader asset class as a whole for reasons that we've already talked about in terms of diversification, inflation hedge, strong risk-adjusted returns. Those models have typically relied on this kind of farmer tenant model. And so, what an institutional investor will typically do is buy a farm and rent it out to the farmer. What we found and this is not in all cases, of course, and this is why I hesitate at using the word broken, oftentimes that farmer is charged a very high rent. That rent can go up or go away. They're not sure of the longevity of that rent over time. They're typically 1 to 3 year rent products. And so while that might provide a good, consistent cash flow return for the institutional investor, it doesn't really align incentives with the farmer. If you're renting a farm or even a house for that matter, you're not likely to make those long-term investments in the quality of the land that are going to really improve the value of that land longer term. We also think from an impact standpoint, we really want to be supporting farmers. These are the folks that are feeding the world on their backs. And we really think that providing a financial solution that also has market-based returns is a really important part of our value system as we think about making these farmland investments. And so, yeah, that's how I think about the world. When we also look at the institutional farmland investment model, I mentioned earlier in the presentation, on average, 2% of farms go for sale every year. Everyone's basically, trying to invest in those farms, including local farmers as well as absentee, as well as institutions. By looking at the co-investment model, we're actually now accessing 50% of all farms in the US. These are the owner-operated farms that I spoke about before, and this allows us to access equity in a responsible way, but in a way that really opens up our market to higher quality farms as well.
Perfect, thanks. So it looks like I got a question. And it says, for an older investor, what is considered long-term with respect to return on investment? So there's a number of things that would go into what would, what to look at on return ROI, basically. I can't talk, sorry about that. Part of it is the age, part of it is, how diversified are you already? And then what's your time horizon? How much liquidity do you actually have? So that's going to be different for everybody. Older investors typically have, say, 10 to 5, maybe at the most a 15-year time horizon. So you definitely want to be careful with what you're investing in. Obviously, a younger investor, say in their 20s or 30s, has a much longer time, which affords them to be a little bit more aggressive with their approach. Let's see. Oh, one more. Might there be any liquidity through selling shares among investors? I'm imagining this directly to an investor if they wanted to sell shares out of the farmland.
Yeah, currently we don't offer, we don't have a secondary market for these investments, but over time that is in the plans. And so really good question. When we look at it, we think about, if you were to make like a series of 10 investments, we're estimating that about 10% of them do an early prepayment per year. So there will be some natural liquidity from farmers buying these out earlier. But of course, creating a secondary market where investors can buy and sell these investments across each other is definitely part of our roadmap. So great question.
I agree. Thank you very much. Okay. So the questions coming in have slowed down. So if you'd like, I think I have a couple I could throw at you. They seem to be pretty obvious, but let's say an investor were to buy a property with, I don't know, let's say 100 acres and started selling it to farmers. I can't imagine they would have the same sort of success that maybe an investment through FBN would have for a number of reasons.
Yeah, so you're saying like what's stopping individuals from just buying a farm on their own? Is that
Exactly?
Kind of, yeah,
Right. The
yeah,
difference.
yeah. So I think there's a number of points here. One is just getting access to good quality farms and farmers through the FBN network. That's one where we have deals that we're evaluating every day, and so we're looking at some of the best farmers in the US are bringing these farms to us. The second is the evaluation side. I've been working in agriculture my entire life, and I still learn something new every time I go to visit a farm. And I think the ability to determine whether a farm is a good farm versus a bad farm is a multivariable decision. And so it's not just about how high the corn is standing or how many bushels you're seeing. It's about consistency over time, and it's about really understanding the data piece between is this good soil? Why is it good soil? Is it resilient against drought? Is it resilient against too much water? How do you think about the performance of this farm, given all the factors that we think about, including things like climate change? And so, we really think data is really the key to our success as it relates to making investment decisions. And so, the average investor might not have those capabilities. If they do, that's awesome. And the last part is just the structuring piece. We spend a lot of time with lawyers and with appraisers and folks to really put these deals together. And so we want to make them as turnkey as possible. And so, we've built the opportunity for farmers to have or investors to have as little amount of friction as possible when making these investments. And so we think that saves time as well as the quality piece I just mentioned.
That's great.
Yeah.
And that's kind of what I figured. So we can go ahead and wrap it up, but I did want to ask, is there a YouTube channel or something that has more information, or is it all on your website?
We do have a landing page where you can kind of input your name and we can get in touch with you to provide more information. We've got all types of email campaigns where we email out new investment opportunities to investors. Send me an email, I can put you on that list or direct you in the right direction. This is a somewhat new product for FBN. We've historically been a farmer facing company, and we're excited to be reaching out to investors. And so if you have interest, please get in touch. Here's my email, and we can get you set up and put you in our database.
Fantastic. Oh, one more question. Annual reporting. What type of annual reporting is provided?
Yeah, because these investments don't have participation in cash flows, there's less on the way of income to be reporting. But as part of our option agreement, we are collecting a lot of information and data from the farmer. So things like what was planted, what were the yields, what was the weather like. And so we'll be providing some annual summary reports on the farms that are invested in, as well as obviously, K1 tax information as well for those investors.
Great, fantastic. Thanks again. So once investors or Rocket Dollar members have their account open, what's the best way to start an investment with FBN?
Get in touch. Again, I'll put folks on the landing page where we can kind of get your name in our system. We'll then start sending you opportunities as they become available. So we're offering SPVs now on a fairly regular cadence. And so we've got live deals available right now, and we'll have more coming in the weeks to come as well. So get in touch. We'll put you on the distribution list, and then hopefully we'll work together in the future.
That's fantastic. Awesome. Thank you very much, Michael. I appreciate you spending the time to sit down and talk with us. If anybody's interested, we're going to have this recording available on our website a little bit later today. And you can also find it on our YouTube channel. So thanks everybody for attending. Have a great day. Take care, Michael. Thank you.
Thank you so much. Have a great day.